Our subscribers really enjoyed this piece, and I hope you do too. We're going to go over 2 tech stocks that are screaming buys, even at all-time highs. Listen, people, they see stock prices, they see the charts, and they say, man, I may have missed the boat, but I'm telling you, there are 2 stocks that you want to have on your radar, and we're going to look at a great historical study of why. But before we do that, I want to go over what's happening in the market. So we can see that the big money index has been in a kind of a downtrend, right? And a lot of people are writing in saying, is this thing broken? It's actually not. It's actually doing exactly what it was designed to do. Remember, if the big money index is heading lower, that means there have to be some stocks that are getting sold. And obviously there have to be some that are getting bought to keep this thing from this range bound action. So let's go ahead and see why that is. If you've got a portfolio, I'm sure you notice that some stocks are going up and some are not. Here is the reason why the major indices are going higher. If we look at the buys and sells by market cap over the past month, you will see something very, very important. If we go to the stocks that are mega caps, right? So these are 300 billion in market cap or more, 62 were bought, 14 were sold. That is 3.4 ratio in favor of buys. So if you can imagine, when the biggest stocks on earth, right? When there are 3 times the amount of buys versus sell, where do you think indexes are going to go? They're going to go up, right? People are excited about AI. They are excited about GLP-1. If you don't have those stocks in your portfolio, you're probably getting more balanced action like you can see in small cap land. So all isn't well in small caps, but when it comes to the mega caps, they are actually pulling the market higher. But let's go ahead and see what areas are expected to grow the most, right? And if you can imagine where a lot of that buying is, as I just told you, they are in tech and in healthcare. Here we're looking at the S&P 500 12-month forward consensus EPS forecast. This is basically saying, okay, of the sectors, what are they expected to grow their earnings next year? And you can see growth areas of the market like technology, comm services, double-digit growth. Healthcare, we have been extremely bullish on this year. They are expecting 14% earnings growth. And also financials is doing well, and discretionary. All 5 of these areas are expected to grow earnings faster than the S&P 500. So we are going to be overweighting those groups. The only negative in this earnings picture is energy, but that can shift on a dime based on supply changes. So there's actually some bullish data there. Even though earnings is expected to decline, there's still some screaming buys. But let's go ahead and look at 2 stocks that are screaming buys even at all-time highs. A lot of times you don't hear that, but something amazing happened recently. Salesforce.com and Meta Platforms, so ticker CRM and ticker META, full disclosure, I've been a very long-term holder of CRM. They both issued and initiated dividends. So CRM, it was 40 cents per quarter. Meta, it's 50 cents per quarter. Here's what we do know going back to 1973. Companies that grow their dividends and initiate their dividend, they tend to have an annual performance of 10.24% compared to non-dividend payers of less than 4%. So you want to be focused on companies that are initiating and growing their dividends. Those tend to be the ones that chug higher year after year. And listen, this stat is thrown around a lot in the research world, but the next chart I think is going to drive home that whenever you focus on outlier stocks, the best of the best companies out there, when they start initiating their dividends, you can see some monster growth in the 1 to 3 years after. So let's go ahead and look at some of the biggest dividend initiations literally of all time. And I went and I did a best effort study here, looked at Microsoft, Home Depot, Walmart, Apple, Starbucks, United Healthcare, MasterCard. Listen, a lot of great names. Here is the key. When they first initiated their dividends, and some of these started in the 1980s, the 1970s, the 2000s, the 2010s. 1 month later, they're up 3.2%. 6 months later, they're up an average of 18.3%. Get this, a year later, after these companies initiated their dividends. They were up 51% with a 100% hit rate. 2 years later, they almost doubled to 93.9%. And 36 months later, they are up 142%. So what does this tell you? If you think you've missed the boat on companies that are issuing their dividends, I'm telling you, this is the kiss of life. It's not the kiss of death. It's not your grandpa and grandma that are investing in dividend stocks. These are some of the best companies on earth. Full disclosure, I do own Microsoft, Home Depot, Walmart, Starbucks, Costco, Nike, and CRM. So listen, these are the types of stocks that we are focused on in our research. Let me show you exactly what that looks like. If you think Salesforce is new to our data, well, think again. Here is a 1-year chart of every single time that Salesforce CRM was on our top 20 reports. So that means we are profiling it to our subscribers saying, hey, it's a good buy here, it's a good one there, it's a good one there. This is where it is over the past year. You want to follow those money flows on high quality stocks. Meta, if you think we missed the boat on that, sorry. We were all over this. When the crowd didn't want Meta, our data said this is a screaming buy. You can see top 20, top 20, top 20, and here they just initiated their dividends. So these are just awesome stocks. You want to keep them on your radar. When you have high quality companies initiating dividends, that is the best case scenario for some of these companies. If you enjoyed this research, make sure to like and subscribe to our YouTube channel. And if you want to find companies similar to CRM and Meta, go over to mapsignals.com, get a subscription, and we can help you on your path to investing. See you later.